Welcome to Magnifi Plus, where we help you invest with intelligence, meaning that with Magnifi, you can now do more than just trade stocks. You can search, you can discover, and invest in the ideas and values that are most important to you using our revolutionary machine learning software. I'm Nicole Lapin, former CNBC, CNN, and Bloomberg anchor, and your host for today. It is a very, very interesting time in the market. Of course, there are a lot of cross currents with a lot of mixed messages out there. Joining us today to make sense of all of it is our pal, Joe Terranova, Senior Managing Director for Virtus Investment Partners. Joe, great to see you.
Oh, thank you for having me. I appreciate the invite. It took a long time, but I'm glad to be here.
It's worth the wait. So give us like a helicopter view of what's going on right now. You've seen it all. So if we were trying to just step back, what are you seeing in today's markets, your concerns, your optimism potentially?
Well, I am optimistic, and I'm optimistic because I think what we're doing is we're normalizing the abnormalities of the last several years. Nicole, if you think about the last 5 to 7 years, there have been so many abnormalities that investors have been able to lean on, and we're kind of washing that away. And the reason for the optimism is I think on the other side of this, we come out with a much healthier market. We come out with a market that restores an understanding of proper fundamentals in a marketplace. We return to a marketplace where margins matter, debt reduction matters, buying back your stock or increasing your dividend matters. It's not concentrating in the direction which we've been able to do over the last 5 to 7 years, concentrating in the direction of some hope or some dream or some belief that at some future point in the not too far distant future, we're going to realize revenue growth and we're going to pay a premium for that. And the reason for all of that is because the Federal Reserve over the last 10 years made a trade with speculators. Nicole, what they basically did was, we're going to trade abundant liquidity for suppressed volatility. So we're going to flood global markets with liquidity. We're going to suppress volatility. We want you in markets taking risk. And if you have an environment where you have abnormally low volatility, what that leads to is not so much bad behavior, but the ability to just kind of passively invest, to concentrate in a particular direction, to avoid a proper understanding of what fundamental valuation is. And over the last 5 to 7 years, concentration in a portfolio was rewarded. And you and I both know, if we're going to construct a portfolio for the long term, we're not going to do it on the premise of concentration. We're going to do it on the premise of believing in more of a diversified story. So we're normalizing all these abnormalities. We come out on the other side in a much healthier place. We restore valuations once again. And I think that's a reason for all of us to be optimistic.
So it's kind of like a volatility volcano, right? Like it was spewing. Where are we in that cycle? Do you think we've seen the low yet for stocks?
Well, I think the volatility regime, there's been a paradigm shift. So moving forward, I would not have the expectation that you'll return to the below average trend of the last 10 years, in which you'll witness the VIX, as an example, trading in the mid to lower teens for a multi-year period. I mean, if you think about 2017, the market basically took the stairs higher, and the VIX traded at levels in the mid-teens, which allowed for an environment that's just so abnormal for investors. So I think you have to have a reasonable expectation whether markets return to their secular bull trend, or if we remain in this cyclical sideways market. In either condition, volatility is going to be much higher than in the experience of the last 10 years. And I think that's been important to kind of communicate. I do that a lot with investors. I do that with financial advisors when I speak to them. And I certainly try and guide to the viewers on CNBC that volatility, the conditions of it have changed, I believe, forever.
Where do you think the terminal rate is going to end?
I think the Federal Reserve is very close. If they are not at the end right now, they are within a few yards of being at the end. Nicole, I believe what we experienced in early March with Silicon Valley Bank, with Signature Bank, and with Credit Suisse is analogous to what we experienced in 1994. If I could walk everyone through that real quickly. If you think about monetary policy, what investors, what individuals like myself always try and do is compare the environment to the past. And a lot of people have improperly communicated that the 2022 monetary tightening cycle, it's reminiscent of what we experienced in the 70s and the 80s. And Nicole, you often hear that Federal Reserve Chairman Jay Powell, well, he doesn't want to be Arthur Burns, who was the Federal Reserve Chairman who made the mistakes stopping and starting on monetary policy in the late 70s. He wants to be more like Paul Volcker. The problem is the conditions of that inflationary environment in the 70s and 80s are totally different than the conditions for the inflationary environment today. This is a pandemic-induced inflationary environment. The inflation of the 70s and 80s, it was all derived from the price of a single barrel of oil. And if you think about what the economy was at that time, it was an economy that was a tangible asset economy. It was airplanes, machinery, automobile. Everything's reliant on a barrel of oil. This is a totally different economy. This is an economy that is an intangible asset economy, AI, algorithms, software programs. So if you reflect back and you try and find the right template, the template is 1994. During that period, Federal Reserve Chairman Alan Greenspan, he raises rates 7 times in the course of 13 months, 300 basis points. And in November of 1994, guess what he does? He raises rates 75 basis points. Sounds eerily similar to what we did in the summer of 2022. Well, 3 weeks later, we find out about the Orange County bankruptcy. Why? Because they could not handle the long-term assets on their balance sheet and the interest rate volatility. And the Orange County bankruptcy, it wasn't isolated just to Southern California. It extended south. For those of us that remember, there was something called the tequila currency crisis. That's regarding the Mexican peso and the stress that it felt there. So what it signaled was peak yields, a trough for equities, and the end to the monetary tightening cycle. The Federal Reserve went one more time. February of 95, they raised rates 50 basis points. By the summer of 1995, they actually were beginning to cut rates. Nicole, I don't think we're in an environment where we're going to cut rates, but the Federal Reserve is at the moment in which they either will pause or in the May meeting or in the meeting subsequent to that, they will have to pause because the effects of Silicon Valley Bank, Signature, and Credit Suisse is tighter credit conditions. And that's actually doing the work for the Federal Reserve. So I think about monetary tightening, and I really suspect, based on the evidence that we see, we're at the end.
Wait, so there weren't NFTs back then? No?
No NFTs back in 94, and crypto was just a twinkle in someone's eye.
Joe, you started in the business as an oil trader. Let's talk a little bit about commodities and gold. Gold is trading at all-time highs. Is gold a good place to invest?
Right now, I believe it is. And one of the reasons for that, it's signaling a disinflationary environment, a very fast disinflationary environment. We're seeing that inflation readings are moderating. We continue to take the staircase, as I like to use as the example. I know everyone wants to very quickly take the elevator lower in inflation. That's not possible. We're taking the steps lower. The peak in inflation at 9.1% was in Q2 of last year. We're coming down very slowly. And because of the effects of now credit tightening, you're seeing the investors are moving towards ownership of gold once again. Because of the disinflationary effect, you're seeing the world's second largest economy finally reopening. They're building their non-dollar denominated reserves back into gold during a period in which, while the economy was frozen, there was an inactivity towards that movement. You're seeing countries like India return as marginal buyers once again in the precious metals market. And because of what we've experienced in commodities overall, understand, when you look at the universe of commodities, a lot of capital that invests in commodities tends to stay within commodities as the asset classes itself. So as you see agriculture begin to decline or see lumber begin to decline, or certainly natural gas decline, which has had this dramatic decline from $9 down to $2, $2.34 as we speak today. It touched below $2. You see the reallocation within the commodity universe, and precious metals, gold and silver, are benefiting there. Full disclosure, I personally am long the GLD. I think that's the right way to get exposure to gold. I don't think you look at gold miners, because in that instance, Nicole, you have idiosyncratic single stock risk. We're talking about wanting exposure to the precious metal itself, and that ETF is the best vehicle from my perspective.
It makes sense. And then what about oil and natural gas? You just mentioned traded off their high, of course, at the beginning of the Ukraine war. What happened there and what will happen?
Natural gas was really all about weather. Remarkable the decline that you saw there. The winter weather, it never materialized here in the United States or over in Europe. How do you reverse this significant downtrend for natural gas? The only way you do that is through future weather conditions that is going to tighten supply. This is about supply. This is not about demand. It is about supply. Supply needs to be constrained. Weather is ultimately the way that you'll see that constrained, whether it's the hurricane season or the winter itself. You'll see some curtailment of production, but Nicole, I don't think that's enough to take natural gas beyond $3 to $3.50. As far as oil itself, we certainly got a surprise when we heard about the cut from OPEC. In certain instances, I'm not so sure we should be surprised, because it was very clear that President Biden's administration didn't have the capital that is needed to go out and begin to refill the strategic petroleum reserve, which they indicated they would do if prices fell in the $65 to $70 level. Well, it did it. They were not there as buyers. So OPEC responded accordingly, announcing the supply cut. And I think what that does is it elevates the range for crude oil, which looked like it was towards 65 to 75. Now I think that range is more 75 to 90. I wouldn't be surprised at some point here in the coming months if we see supply challenges from weather, the same type of weather challenges that could affect natural gas. If you were to see natural gas and crude oil both push higher, that would take crude oil uncomfortably close to $100.
Okay, so back to the twinkle in some crypto bros, baby crypto bro, probably at that point, of the 90s. What are your thoughts on crypto? You know, folks think it's the new commodity. How much should people have in their portfolio?
So I believe in the 1% rule. I believe in educating yourself, and that's what we all should be doing right now. I'll raise my hand. I'll be the first to say that I believe that I understand crypto, and then 10 minutes later, I tend to forget everything that I thought I knew in understanding why it benefits a portfolio. If you think about a portfolio and its construction and the usage of a particular asset within the portfolio, what is remarkable to me is that what you have to do is you first have to traditionalize the asset. And Nicole, I think you and I would agree, I'm not sure that crypto has been traditionalized as an asset class just yet. And I think the reasons for that come in the type of hyper volatility that we associate with crypto and the extreme price movements, the significant drawdowns, and then the very large price spikes that we see for Bitcoin and for Ethereum. And I think the way that ultimately crypto gets to traditionalizing itself as an asset class is if you begin to normalize the volatility with other traditional assets and normalize the price returns. So if the price returns become similar to what you might be able to achieve in domestic equities or global equities or even select bonds, and you're witnessing over a multi-year period return range between 5 to 10%, that's where I'm more comfortable. And I think the crypto enthusiasts ultimately are going to have to begin to get comfortable in understanding that the way that you validate crypto as an asset class is not through price appreciation. Crypto doesn't validate itself because it goes to 100,000. crypto validates itself because it has similar characteristics in volatility and return performance to other assets that we would utilize in a portfolio. And the last point on that, I think there's going to be a dramatic consolidation within the crypto universe, and ultimately on the other side of that, and I think you're seeing that now. I think it's Bitcoin and it's Bitcoin itself and Ethereum as well, where the investor focus or isolation, if you would, will be maintained as we look forward. But 1% is clearly the educational portfolio allocation that I would have. And full disclosure, I have no exposure to crypto right now because I don't have what I believe is a strong enough understanding of it.
So 1% of your overall portfolio, the theory behind that is you can afford to lose 1%, right? But maybe kind of can't afford to miss out on the gains if 1% becomes 100%.
How many people have the discipline to maintain the 1%, though? That's the remarkable part of it. Listen,
you don't, clearly. So
Paul Tudor Jones, okay, was on CNBC a year and a half ago. It was amazing just watching his process of understanding the importance of discipline in constructing a portfolio. And here's Paul Tudor Jones, one of the most legendary traders ever to grace the finance industry, a multi-billionaire, and he's talking about how he's got 1% positioning and doesn't go over that 1% positioning. I guess that's why he's Paul Tudor Jones.
I was just going to say, yeah,
very difficult for individuals to maintain the discipline to adhere to a 1% portfolio allocation.
All right, Joe, let's take a look at Joe T, the quality momentum index that you run. First of all, what is quality momentum?
Okay, so quality momentum was created in response to what I would hear sitting at CNBC. So for the better part of 3 or 4 years, 2013, 14, 15, 16, I've had individuals that would come on the show, they would sit next to us and they would talk about a particular stock. Whatever, pick your favorite stock if you would for a second, Nicole. What's your favorite stock to talk about?
Disney.
Disney. Okay, so they'd come on and they'd talk about the Mouse House. And they would say, okay, Disney right now is trading $150. It's at a 18-month high. And then they would tell you all the wonderful stories about the film studio. They would talk about Disney Plus. They would talk about all the fundamental expectations that they would have about Disney, okay? And then they'd kind of get offset and you'd have an off-camera conversation with them. And in the off-camera conversation, ultimately, the real referendum for why they own Disney was because the price was going up. That's really why they own Disney. They looked at what we know to be momentum, and they studied price movement, and that seemed to be the single determinant for their ownership. I believed that utilizing as a strategy a single factor of momentum should be dismissed. You should respect price momentum. You should always respect price momentum. But I believe you needed something more, because in a market that ultimately at some point was going to reverse itself, which in fact we did starting in 2021, you would then expose yourself to outsized risk. So listening and curating that in my mind, I knew that I could bring forward a product that would combine two factors. It would take the confidence that's represented in the strength of technicals, momentum, and then combine that with the strength of fundamentals, looking at balance sheets, looking at debt to equity, return to equity, and then from a proprietary nature, studying what revenue growth is over a 36-month period. We call that quality. Two factors brought together into one product to act as a shock absorber if, in fact, markets experienced corrective behavior, which is exactly what unfolded. And quite candidly, Nicole, we incepted in November of 2020, and I am extremely happy with the way the product has served the end user in mitigating risk with just having an exposure to the single factor of momentum itself.
Okay, so let's take a look at it. Let's take a look and compare the performance and the price earning against the S&P 500. So we can do this using Magnifi, which gives individual investors access to the information that was only available to institutional investors, like you would need a Bloomberg terminal.
Very expensive.
It's democratized now, Joe, which is very cool. So we can see Joe T and SPY. Joe T is down less than SPY. So that's a win. Your multiple is less than the market, 400 basis points below market. Why is that?
So I think what's important to understand is the privileged position I have sitting on CNBC. The quality momentum strategy is measured against everything else. It's measured against the S&P. It's measured against the NASDAQ. It's measured against momentum. It's measured against quality. It's measured against Russell. It's measured against everything. And the critical analysis suggests that this strategy from a performance perspective should outperform everything. In fact, what this strategy is attempting to do is it's trying to recreate, redefine momentum itself. And it's also looking at what I call a core equity holding, which in fact could be the S&P 500, and improve upon the fundamental conditions within that strategy. So if you look at the price to earnings of quality momentum, which is represented in Joe T, relative to the S&P, you will see that we have a lower PE than the S&P. The reasoning for that is, number one, the product is equally weighted versus the S&P, which is obviously market cap weighted. And the ownership of select sectors is far more diversified than the S&P itself. So if you look at the sector allocations, you'll find that we are underweight technology, which has a relatively high PE. We are underweight communication services. We are underweight consumer discretionary. We are overweight areas of the market where you'll find a lower valuation, such as healthcare, energy, industrials, and financials. So I believe that represents exactly what we're attempting to do by overlaying quality as a factor on top of momentum. You know, Nicole, if I could, it all begins with momentum. Let's understand that. There's 500 US large cap companies. That's the universe. We take that 500 US large cap universe and we initially narrow that down to 250 names based on what? Momentum, because everything begins with momentum. We screen based on momentum to get to 250. And then the quality factor is introduced. The triple criteria of return on equity, debt to equity, and sales growth over the last 36 months allows us to narrow the 250 universe to 125 names. And the 125 names are what will encompass the index. It will be rebalanced and reconstituted on a quarterly basis, which with what I believe is a very unique construction predicated on the calendar. We don't rebalance and reconstitute based on the quarter. What we do is we rebalance and we reconstitute based on earnings. So at the end of January, the end of April, the end of July, and the end of October, that's when we will rebalance and reconstitute. Well, why is that important? And how does it correlate with earnings? It correlates because we will begin to have the S&P 500 reporting season in the second week of each of those months. So we're able to capture, most importantly, the latest revenue growth numbers within our calculations of understanding quality. Now, obviously, the entirety of the S&P earnings season has not been completed by the end of January, but we're able to capture a significant enough percentage that I feel comfortable that it is a differentiator.
That sounds like real sell discipline.
Sell discipline is one of the most important behaviors that is absolutely mandated for success and survival in this industry, whether you are an individual trader, whether you are a shorter term investor, or whether you are a long-term investor. That must be prioritized to succeed.
Amen. Virtus, of course, issued Joe T as an ETF rather than a mutual fund. Can you just quickly explain the difference between the two and tell us why Virtus decided to offer the index as an ETF? I mean, it sounds like you also like bonds as an investment, but you run a securities stocks ETF. Tell us the difference between the two and why you guys decided to go that way.
I believe because of my visibility on CNBC, utilizing an ETF as the vehicle was the proper way to deliver this product to the end user. I think there's advantages to utilizing mutual funds in certain instances, and I believe there's an obvious gravitation towards ETFs as we have moved through the course of time. We see the growth of ETFs. I obviously am a big believer of the ETF model itself. And then it allowed us obviously to assign a unique ticker symbol that would afford the potential investor the opportunity that understood this in fact represents the philosophy, the approach, the awareness, the observations of what Joe has seen successful investors incorporate into their portfolios and what I myself believe in and what I have done in terms of my investing and trading in prior instances going back a couple of decades.
Yeah, I mean, it's a pretty sweet ticker. How did you get that, by the way? And how do I get like Nick L?
Well, I think that the reason that, first of all, it was obviously available, and we'll have to see if Nick L is available for you, but I wanted my signature. I wanted my returns to be visible. I think that's important. You know, I think if you're public facing, if you're client facing, and you have a product that is the conception of your intellectual belief surrounding investing, then you have to put your signature on it. I 100% believe in that. So it's not some vanity call that the ETF is Joe T. It's okay. Here's Joe T. Here's the philosophy, the beliefs, the understanding of markets, and how to, as you say, how to apply a sell discipline to that, right? And you can either invest in that strategy, or quite candidly, if you disagree, you could turn and look away. And if you strongly disagree, well, there's options on the ETF. So you could go in and you could buy some puts on the belief that it's going to fail.
Listen, you're putting your money where your mouth is. Like, you get the credit when it goes up or does better than the S&P or less bad, but you also get flack the other way.
I'm fine with that. The majority of the capital that I have invested in the market is in this product. And as we move into the future, that will only grow more and more. Nicole, ultimately, I believe my children will, when I'm long gone, look at this product and realize the value creation that it provided to investors. I believe many years from now, if we're able to look back and everything that I understood, believed, sitting at that desk on CNBC as a needed requirement to introduce a new product, introducing the product itself, the growth of the product, wonderful opportunities like today to talk and share about what the product ultimately is. I truly believe that many decades from now, if investors are calling up Joe T on their screen and able to execute on it, then I have successfully done what I attempted to do, which was to create a core equity holding that would be advantageous and productive for investors in their portfolio.
Joe T, thank you so much.
Nicole, it was a pleasure. Health and happiness to you, the family, and all the viewers.
Back at ya. So let me show you how to use Magnifi's research capabilities to help you analyze different investment opportunities. We talked about the ETF Joe T. So let's use Magnifi, which is like Google for investments, and research Joe T. Take a look. I just type in Joe T in the search bar, and here's what we get. If I select top holdings, I can then hover over each shaded area to see the holding percentages. What's unique and robust about Magnifi is that it's accessing more than 3,000 data points using AI in real time. There is no other way to invest anymore. Great information today, and most of all, a great way for all of you watching to make better informed investment decisions. For more information on investing with intelligence, please visit us at magnifi.com.